Morning, everybody. We're just going to take a minute to let everybody in and then we'll start.
There's like a moment of silence.
Yeah, I know. Okay, Sans, what do you think we should start?
Yes, please go ahead.
Okay, thanks everybody. My name's Danny Cohen. I'm from Prologue Consulting. I'm going to be the moderator this morning. I'd like to welcome you all this morning to the launch of the Q2 21 Altron FinTech Short-Term Credit Impact Index, which we're calling the AFSCI, which is much easier to remember than the Altron FinTech Short-Term Credit Impact Index. I am going to introduce today's speakers. Today we have got Johan Galatli, who's the MD of Altron FinTech, and Keith Lockwood, who's an independent economic consultant and adjunct faculty member at Gibbs. And Keith is the one who prepared the AFSCI on behalf of Altron FinTech. For some of you, we're welcoming you back from the first launch of the AFSCI, which was in September. The idea behind the AFSCI is that it tracks the economic impact of short-term lending in South Africa. And this is to both help credit providers in the critical microfinance sector in their assessment of risk and credit extension. And so the first AFSCI was launched in September 21, and Altron FinTech explained then that they were going to provide quarterly updates. And so that's what we're here for today. Just to give you a little bit of housekeeping, we're going to try and keep this as informal as possible and as brief as possible because we know that everybody's got lots of commitments and Zoom fatigue. So just to clarify, there is a press release, there is a presentation, and there is a report. These are all going to be uploaded to the Altron FinTech website, and we will post a link in the chat. We're also going to post a copy of the press release and the report, as well as Sandra's contact details and my contact details. So if any of you didn't manage to get a copy, please mail us and we'll help you. Also, if any of you would like to arrange an interview after the presentation with either Johan or Keith, please let one of the two of us know. Just to remind you all, please to keep it on mute while the presenters are speaking. And once they finish, we'll go into a Q&A, and very informal. You're welcome to just put your hand up or post a question in the chat, and we'll allow you to ask any questions, and hopefully you'll get the answers that you're looking for. And my final point I just wanted to add is that this is being recorded, and anybody who wants a copy of the recording, please let Sandra or me know, and we'll make sure we send it to you afterwards. So without any further ado, I'd like to hand over to Johan to introduce today's release of the results. Thank you.
Thank you, Danny. Thank you for hosting. Thank you for all the media that are attending this morning's session. This is our small contribution with the assistance of Keith. He's really the star of the show today. So we're merely trying to assist with an Altron strategic initiative. And one of the pillars is financial inclusion. And we play a very important role of providing technology that assists with ensuring that our customers follow the regulation and compliance requirements of the National Credit Regulator. So our feeling was when we started working with Keith that there's very little measurement of how the unsecured credit market is contributing to the growth, the economic growth of South Africa. And putting the index together, Keith has done a sterling job for us of putting the contributions in the various contributing growth areas. So for us, the first report and the first index was very encouraging, and Keith will detail today how the two indexes compare to each other, and hopefully by maintaining the cadence of releasing these every quarter, we could inform policymakers and regulators of where we need to feel assistance in growth sectors in our country, because the ultimate goal of this is to increase the employment of people in our country. And from Keith's research, this is certainly an industry that could get assistance from government and to grow the sector. So thank you, Danny, and over to you, Keith.
Great, thanks, Johan, and welcome everyone. I'm going to just share my screen so I can set up a presentation that will just summarize what I have to say. There we go. All right, so as Johannes said, this is the second in this series of indices that Altron FinTech are publishing. And what we're really trying to do is track the impact of short-term credit extension on the economy. Okay, just in case there are people who weren't present in the first at the first release, I think it's worth just summarizing again what short-term credit is about. So remember, this is loans with a maximum value of 8,000 Rand and a term of up to 6 months. And I think the important issues here are, first of all, that this is money that is generally advanced outside of the formal banking system. So it's done by individuals and institutions that use their own capital rather than the deposits of their clients. It is important because it often is the first access point for people trying to access credit for the first time. It certainly, as you'll see from the results, provides lower income households with a much bigger share of the credit that's advanced. It's a source of funding for low income households and people with limited wealth assets to see them through unforeseen developments and emergencies. It provides finance to micro businesses that can fund working capital and stock and asset purchases. And I think ultimately it's really a barometer of the financial health of a vulnerable and often neglected portion of South Africa's population. So that's really why we are choosing to focus on this particular market segment. And the reality is that currently it's small in the context of overall consumer credit. But we want to deepen our understanding of it and analyze the role that it plays in the economy. So if we look just more generally at what's happened to credit extension of different types since the COVID epidemic or pandemic began. So this is taking each of the different types of consumer credit and indexing them back to the first quarter of 2020, when we didn't really have evidence of COVID. The first cases hadn't appeared. And then looking at what's happened to the value of the new credit advanced in each of these different market segments. And what you can see is you had that very steep decline, in one case up to 75% reduction in lending in the second quarter of 2020 when the lockdown was at its most severe. And since then, we've seen a recovery for most types of credit. And in fact, most of the types of credit are now above their pre-COVID levels. Total credit is sitting at about 16% more than its pre-COVID level, thanks almost exclusively to a massive increase in mortgage lending. But then we also see that secured credit is up. The short-term credit is also up above its pre-COVID levels. And in fact, the only two categories of lending that are still below their pre-COVID levels are developmental credit and unsecured credit. So again, if we look at the total consumer credit market, then one of the things that is apparent is that close to 2/3, in fact, of new credit applications are still being rejected by credit providers. Okay, it's not quite as high as it was in the second quarter of last year, but it did tick up between the first and second quarters of this year. So we're sitting at 64% of all consumer credit applications are currently being rejected. And that has got to tell you that the financial position of many consumers is still under significant pressure. And the most significant contributors and evidence we have for that is in relation to real per capita GDP. So we know that for many quarters, the rate of growth in the economy has been lower than the rate of population growth. So on a per capita basis, real GDP has been declining. So if you look at since 2015, of those 26 quarters that we have data for, there were declines in real per capita GDP in 20 of those 26 quarters. And of course, the big decline happened in the second quarter of last year. We do have an encouraging increase in the latest quarter, but even so, we're still sitting with real per capita GDP that's 7% below its 2015 levels. And then the other big contributing factor to this is obviously employment. So we haven't seen quite as many negative or declines in employment on a year-on-year basis, but still we did see a big drop of over 13% in the second quarter last year. Again, it's recovered, but even so, we're still sitting with total employment in the economy that's about 3% less than it was in 2015. Now, at about 11 o'clock, Stats SA will be releasing the third quarterly labor force survey, and we should get some picture of what's happening to employment in that context then. Okay, so that's still the general consumer credit market. What's encouraging, though, is that in the short-term space, we saw this uptick in the gross debtors book. So remember, the gross debtors book is really a stock value, and it reflects the opening balance of loans that are on the books, plus any new loans that are extended, less any loans that are repaid or written off. And so what we have seen in this latest quarter is that, in fact, the debtors book of short-term lenders has increased. And the reason for that is that the value of new loans advanced was higher than the value of loans written off or repaid, to the tune of about 52 million rand. The other encouraging thing in this context, though, is that the number of new loans advanced has now risen on a year-on-year basis by 83%. So after that very big drop in the second quarter of last year, we have seen this very significant recovery in lending activities in this sector. All right, the other interesting dynamic that's come into play here is in relation to the term structure of the lending. So what we've seen is that over time, the proportion of lending that's going to loans with a term of between 3 and 6 months has increased from 19% at the start of 2015. And in the latest quarter, it was sitting at 51%. loans with a term of between 2 and 3 months, gone from 7% of total new loans advanced to 13%. And the loans with a term of up to 1 month have dropped from 74% to 35%. And that whole trend has been accelerated during the COVID period. So we look at the graph on the right, what we see is in the first quarter of 2020, what was the value, the combined value of loans of different terms, and then what's happened to that by the second quarter of 2021. So we see that the total value of loans with a term of up to 1 month has dropped from close to 1.1 billion a year ago to about 780 million in the latest quarter that we have data for. But when we look at the 2 to 3 month and 3 to 6 month loans, we see very significant increases. So 2 to 3 month loans have gone up 25%, and 3 to 6 month loans have gone up by 42%. Okay, another interesting aspect of the lending has just been how the value of short-term loans advanced has increased at a faster rate than both the GDP per capita at current prices and the consumer price index over a similar period. So that suggests that lenders there's a particular incentive structure in place for lenders to increase the value of loans. So that could be a function both of the consumer need, so consumers are applying for higher value loans, but it could also be a reflection, I think, of the fact that this particular market segment sits with an interest rate cap in terms of the National Credit Act, and then it's got limitations on interest and fees, different fees that are essentially have been the same since 2015 when they were reviewed. So there's been no inflationary adjustment to any of those limits. So if you think about it from a lender's perspective, the one way to compensate for the effects of inflation is to increase the value of your loans. But obviously you have to do that in the context of a risk assessment anyway. Okay, I mentioned earlier that one of the key characteristics of this particular market segment is that it's a much more accessible segment for lower income households. And just to highlight this again, if we look at the second quarter total credit extension in the graph on the left-hand side, you see that people with monthly incomes of more than 15,000 Rand received 89% of that credit that was advanced. So that effectively means that everyone with income less than 15,000 Rand a month combined got the other 11%. But when we look at short-term credit in the graph on the right-hand side, then in fact the share of total lending going to people with incomes of less than 15,000 is 58% of the total. And you can see the different segments and income categories and what their share of that lending has been. Okay, so if we take that additional lending that's occurred, and then we look at who got what proportion of that lending in terms of the income groups, then on a comparative basis with the second quarter of 2020, we see that in fact the lower income groups have received a bigger share of this this additional credit that's been advanced. So people earning 3,500 Rand a month or less got an extra 24 million Rand in spending capacity, essentially, while those earning between 3,500 and 5.5 grand got about 57 million. And those in the income category earning more than 15,000 only received 8 million of this additional credit that was extended. Now, one of the commitments we made with Altron in the context of this index was that we would try to expand our understanding of this particular market segment over time using the data that Altron FinTech is able to collect. So we, in this particular case, we are focusing a little bit on the gender behavior of lending and the patterns that are evident. And what emerges is that it's a exceptionally gender equal kind of an activity. So we see that females received 51% of all the credit advanced, and males over a 3-month period received 49%. Now, as it happens, that is exactly aligned with the population demographics of the country. So in South Africa, females outnumber males slightly by 51% to 49%. So we can conclude that in this context, at least, there's gender parity. And you see that as well in the context of the average value of loans advanced. In fact, there's a marginally higher level for females, but it's not statistically relevant. So for the most part, you can see that the average loan values for males and females are essentially the same. Okay, so if we now go to the index, remember this index is reflecting the economic impact of short-term lending on the economy. And essentially that impact arises from the additional sales that are facilitated, because ultimately the sales support employment and they also generate taxes for government. So the sales values have gone up. The sales supported has gone up, but the overall index has gone from 94 to 96 in the latest quarter. As you can see, it's still a long way off its peak levels that occurred in the fourth quarter of 2015, but it's recovering. It's getting back up, and hopefully will gain some more momentum in the quarters ahead. So if we look at a sort of relative to a pre-COVID level, then we see that the debtors book is still sitting at about 90% of its pre-COVID level. But in terms of new advances, the short-term credit advances in the latest quarter were actually higher than the pre-COVID levels by about 4%. Okay, so if we want to summarize the impact of this credit extension, both in relation to the previous quarter and in relation to a year ago, then the graph on the left is telling us that the additional credit extended in this period supported an additional 153 million rand of sales throughout the economy. And if you want to get an understanding of how that multiplier effect works, in the actual publication that accompanies this release, there is an annexure which explains that quite in some detail. And then if we look at the additional employment supported, went up 265 jobs in terms of the multiplier effects. And in terms of taxes collected, compared to the first quarter of this year, the government was able to collect an additional 19 million rand of taxes. If we look at a year-on-year basis, then economy-wide sales have increased by close to 460 million rand, 795 or close to 800 additional jobs are being supported, and the government has been able to collect an additional 56 million rand in taxes. Okay, so the last thing I wanted to do was just think about what would the implications for the economy be if net short-term credit extension was to be increased by 1 billion rand. So in the context of our earlier discussions, that would mean that the gross debtors book of short-term lenders would go up by 1 billion rand. And what you can see here is that currently the sales that are supported on the basis of the existing credit extension amount to around 5.8 billion rand. So that level of credit extension that's currently in place is supporting sales throughout the economy of 5.8 billion. If we were to add an additional 1 billion rand of lending on top of that, then we would see the sales throughout the economy increase by a further 2.9 billion rand on top of that. So that would take us up to what, 8.7 billion. In terms of employment that's supported, currently about just over 10,000 jobs are supported, and that would increase by close to 50% if you were to add an extra billion into the amount of lending. And then in terms of taxes collected, government currently collecting around 706 million rand of taxes based on existing credit extension in the short-term market, and that would go up by another 362 million. So one of the questions I guess we have to ask ourselves is what is stopping this market from growing? And obviously I touched earlier on the financial position and credit worthiness of households in South Africa. And we know that particularly lower income households have been under particular stress because they are more susceptible to employment loss, and their incomes haven't necessarily kept pace with inflation. But I think we also have to look at the regulatory environment, the fact that we have got this market segment where it's not using depositors' funds per se, but the capital of the credit providers themselves. And so if we were able to stimulate that kind of lending, then we could expect some significant multiplier effects to arise throughout the economy from that sort of lending. So in the coming quarters, we are going to try and unpack again and deepen our understanding on who's borrowing in this market, and what the money is being used for. And so hopefully that will give us a better idea of what we could actually achieve through additional lending in this space. Okay, I think that's all I want to say for now. So I'm not sure if there's anyone who's got questions. I'm happy to take them.
Thanks. That was great, Keith. Thanks very much. And thanks, Johan, for your opening comments. Any questions? I've got a couple that have come through to me on WhatsApp, but have any of the media who we've got online got any questions? Okay, let's start with the ones I've got already. So actually, I've got two questions that came through that were in some ways linked. And I think maybe it would be helpful if both Keith and Johan responded to them. So the first question is, you mentioned the upside benefits, Keith, around the R1 billion that short-term credit, R1 billion of short-term credit could provide. What needs to happen to unlock that value? That was the one question. And then the second one from somebody else, but it is related, is what policy interventions are needed or changes to regulation? What kind of assistance is needed from government in particular in order to unlock this kind of value?
So I suspect that Johan might well have some more sort of pertinent industry insights into what is inhibiting lending. And I think that's one of the areas that certainly would warrant some additional investigation. But it does strike me that, you know, even with an additional R1 billion of lending, we would still be quite a bit below the 2015 level. So at that point in time, there were different dynamics. Obviously, the economy's moved on. We've been through a fairly extended period of low economic growth and negative economic growth, as my earlier graphs indicated. So you could look on the demand side for credit and say, well, what has happened there? And it could well be that the demand for this credit in terms of effective demand, because if we look at the rejections of applications, we can see that a significant portion of those applications are rejected already, close to 2/3. So that could reflect on the fact that it's not so much people's need for credit that's the problem, but their ability or their perceived ability to repay it. But I think on the supply side, we must also understand that, as I indicated, this particular market segment is regulated in terms of the National Credit Act. So it's got an interest rate cap, and it's got a loan value cap, effectively, and then it's got limitations on the fees that can be charged. And so you could argue that the combination of those things has affected the profitability of lending in this market segment. And that obviously is something that policymakers would need to look at to say, is there a way to address this in a way that can be productive for the economy, especially given the relative importance of lending, for example, to micro businesses. So if you were able to channel additional funding into micro businesses, you would have beneficial impacts on employment and on general economic activity in many of these market segments that we're focusing on with this index. So the lower income household segment, if you like. And so I think there's certainly work to be done in this area, and hopefully some of the research we're going to do in the quarters ahead will help shed some light on this. But it does seem to me that you've got this combination of the demand side impacts of creditworthiness and financial pressure, and then you've got the supply side impacts on what the relative attractiveness of the segment and what institutions and individuals are willing to do. So the other interesting thing, I think, and the dynamic we'd have to try and understand is, has a significant portion of the existing lending base, because of the administrative burden that's imposed by the National Credit Act, have they chosen to move into the informal lending space? And that I can't answer because I don't have any research to prove it. But that would be a pointer to the fact that the existing regulatory environment is not conducive to formal lending in this space.
Johan, thank you very much, Keith. Johan, is there anything you'd like to add to that?
Yeah, for me, it's extremely encouraging to see how the multiplier effect comes into play when this segment increases its economic activity, and for me, that multiplier effect is what we really need in our country. And Keith's results and research have clearly indicated that for us. So, but not to reiterate what Keith has said in the start, is that this form of credit is funded by personal funds, i.e. people who've made money and now they see that this is a business segment that they would like to penetrate, and they are making their funds available. So this is a high risk environment for them, and they need to make some profits for them to get some return on this investment. So if one goes back to Keith's slide where he shows that dramatic drop off in Q4 in 2015. So there is very little kind of causal research done on what gave rise to that drop off, to where we find ourselves at levels now that's about half the levels that it was in 2015. So if we take that value in the last quarter of 2015 and we apply Keith's multiplying criteria, I mean the numbers are staggering. So for me, there's a clear trend here that we can take heart from, and we can extrapolate from those levels of what contribution this segment of credit can make to this African growth story. yeah, so for me, it's extremely encouraging, and I'm excited to see what's going to happen going forward.
Brilliant. Sasha, I saw you went off mute. Did you have a question and then decide not to ask it?
Yeah, that's exactly what happened.
Okay, no problem.
Thanks, Dan.
No problem. Anybody else? Okay, I've got one more question that's come through to me. Keith, do you see the latest developments in respect of the nasty new variant, Omicron, and the shutdown of tourism over this holiday season having any impact on the AFSCI or on the market?
Yeah, so this is it's still relatively early days, and it's hard to know what the full impact will be. I mean, we hope that they're going to discover fairly quickly that maybe this virus isn't, although it might spread aggressively, maybe it's a milder version that people recover from quite quickly. And if that is the case, I'm not an epidemiologist or anything, but I understand that sort of evolution of a virus is actually quite an encouraging thing, because it essentially enables people to build up their immunity without causing huge disruption or the kind of disruption we've seen. So we don't know yet what the situation is, and I wouldn't like to play in that field, but I certainly hope that the impacts can be relatively short-lived. It is hitting a particularly vulnerable sector of the economy, the tourism space, at a critical time. Many of those people have been holding on by their fingernails for an extended period of time. And when you see some of the scenes from the airports of foreigners who had already made the effort to come out here and now rushing to go back, that clearly is worrying. So hopefully we can get back to a situation where, firstly, South Africa doesn't get punished because its scientists do a good job and a responsible job, but also that those kind of economic segments can actually start benefiting from a normalization of economic activity. So as things stand, it's certainly not great. I mean, this economy has been struggling to gain momentum, and every time we put a few steps forward, now we're getting hit by another sucker punch. So hopefully, the impacts will be relatively short-lived, but it's certainly not something that we can celebrate at all.
No. Someone described it to me yesterday as the black swan event of a black swan event, which was a good way of putting it.
I want to contribute to Keith's words. At least we have to commend the government, for their stance on the new wave, if I can call it that. So at least we haven't gone back to punishing the economy further with further lockdown there, because that places has a severe impact on the economy. So I would like to congratulate the government and commend them for taking a very measured view on how this thing is going to play out in our economy, and also for taking sound advice from our wonderful scientists that we have in our country, and their guidance on how we should manage this process going forward. So I support Keith in his comments in terms of tourism. It has got a multiplying effect that you can't even measure. I think if you shut down tourism to Europe, economies won't even last, because it's got such a huge impact and a knock-on effect. Because most of the people that provide services into the tourism industries are the very people that makes use of this credit for their own growth. So if they don't have employment, they can't even access this credit. So for me, that's the two sides of the coin that we're monitoring very closely.
Thank you. Okay, one last ask. Anybody else got any questions? Okay, Keith and Johan, I'm going to give you each a minute or two to give us some closing remarks. Would you like to start with Keith?
Okay, well, I think we are sitting at a situation where some of the disruptive effects of the pandemic are starting now to work their way out of the system. Well, at least I thought so until the latest variant came through. But hopefully, given that measured response of government, we're not going to see another harsh lockdown being imposed. And so we are seeing this kind of normalization of lending activity. And I think that's reflected in the encouraging uptick in the value of lending and the number of loans that are being advanced in the segment, and also then in the index in terms of its impact on the broader economy. So in that sense, I'm encouraged, and I'm looking forward to the coming quarters to see how that credit activity can be sustained and hopefully expanded going forward.
Thank you, Keith. I would like to thank everybody involved in organizing this, Sandra and Danny. Thank you for that. And I would like to support the government. Let's have a measured view on this. Keep our country's doors open, and let's encourage the tourists to come to our country. Thank you very much.
Okay, thank you very much, everybody who attended. I've just got a couple of reminders to tell you. First of all, on the back of the comments around the pandemic, please, all of you, if you aren't vaccinated yet, go and get vaccinated and take your family members to get vaccinated. Sandra and I have put the media release in there. If anybody wants a copy, they can contact us. You know where to find us if you want to do an interview with either Keith or Johan. And then just to add, as some of you will know, and you'll see it from the invitation we sent out, Altron FinTech have commissioned 2 indices. So first there's the AFSCI. The other one is the AFRI, which is the Altron FinTech Household Resilience, Financial Resilience Index, the AFRI. And the results, the Q2 results of that are going to be released at 10 o'clock on Thursday morning, the 2nd of December. So for those of you who are on here, it would be great if you're available to join us there. They are not directly linked, but there is a strong link between the two, which we'll be chatting about on Thursday morning when we release those results as well. So thank you very much to Keith. Thanks to Johan, and thanks to all of you for joining us. Bye.
Right. Thanks, everyone. Bye.